Thank you for joining me of the first episode of my asset score. My job has allowed me to see how people or a lot of different people have built wealth. So I would say most of my clients are in the upper middle class to upper class of coastal California area in terms of wealth brackets. And so I've gotten to see quite a few ways that people have built considerable sums. I'm really dedicating this channel to trying to pass on some of these tools to especially business owners right now, but anyone who kind of falls into that middle class and is struggling to create wealth from things other than just their labor. The way the tax code and economics works currently, labor is not favored in terms of ways to increase your wealth, and it's really a game of asset accumulation. And I'm trying to give a tool. My asset score is a calculation tool that I'm trying to pass on that allows you to kind of keep track of where you fall or the progress that you're making in terms of playing this game. And I don't mean to make light of it in terms of calling it a game, but I kind of want to gamify some of the concepts here so it's not so dry and it's such a drag. So I think I want to start off by first talking about just kind of different classifications of ways people make money. The first one being a standard like W-2 employee. And this is if you work for a company. Let's say you work for Target and you get a paycheck and they withhold taxes and Medi-Cal and Medicare out of it and Social Security. That's a W-2 employee. You could also be an independent contractor. This is when you're hired to do a specific job for a set amount of money. There's generally no withholding out of that, and you would usually file that on a 1099 on your tax return, and you have to do your own withholding on that. There's also owner-operators of businesses. These are people, let's take a restaurant owner, for example. If you have a family restaurant and you work there and you own the restaurant, but your labor is also there, so you're an owner-operator. And this kind of works on a scale. So the more involved you are, probably the less the business is worth. And the less involved you are, probably the more the business is worth. And that's because your labor is built into the value of the restaurant. And so if someone else were to buy that restaurant from you or buy that business from you, if you're not so involved, they're buying a business that can self-manage or kind of self-operate. If you're heavily involved, a certain portion of that sale would be for your labor, which probably would not be carried on in the future. So they're going to pay less for it. And finally, we have what I call like a serial entrepreneur. These are people that have the ability to kind of start businesses, create value, and then sell or exit the business in such a way where they can get a good chunk of money, and then maybe they do this process over again. But they have moved on from the business with a substantial sum, and then they can go start another business or get involved in something else. This is probably the most misused category. I think everyone who doesn't have a boss calls themselves an entrepreneur, but really, if you're creating a business where you are the value, you're probably not creating a marketable venture that someone's going to buy from you. You probably definitely fall more into that owner-operator category, and you're not really building an asset apart from yourself, or not so much. But the real key here is, or the takeaway here is that people who are doing well in this game of asset accumulation are able to convert or take the cash flow they generate from any of these things and convert them into marketable assets. The first being is just public markets, and this is what you think of as stock or anything else you could buy at some kind of publicly traded market. It would also include things like mutual funds or ETFs. And this is, in all honesty, this is probably where most people should start investing is through public markets, and probably in some large ETF through like Vanguard or Schwab or kind of some safe vehicle like that. People also invest in real estate, things like rental properties, or now there's new things like Fundrise or kind of these fractional share, like they're like ETFs but for real estate. There's some disagreement on whether like a primary residence would fall into this category. I think most people would think primary residence real estate should not be considered like an investment asset because you live there, and so it doesn't generate cash flow or anything like that. So we'll probably leave that off for most of our purposes. There can also be some other miscellaneous assets, alternative markets, and then private markets. I would say these are things where, like, if you're an angel investor or a hedge fund that you have access to that kind of the general investor would not have access to. So I'd like to get into all these things in more detail in future episodes, but I think the point here is, or for this first episode, is really this cash flow conversion idea. And no matter how much you make, if you can't convert assets or convert cash flow into marketable assets, your wealth is not really growing. And so if you were making $1 million a year versus $10,000 a year, it's obviously easier to do this with $1 million a year. But if the person with $10,000 a year is able to do this at some level, and the person with $1 million is not able to do it at any level, the person with $10,000 is increasing kind of their net worth, and the person with $1 million is not. And so kind of the tool that we recommend using is what we call my asset score. And basically what you're doing is you're taking your marketable assets and you divide that by your annual spend times 25. And so in this case, let's just take it for instance, if you have $400,000 in marketable assets and your annual spend is $90,000 times 25 for 25 years, you have an asset score of 0.17. You really want this asset score to be 1 or above, which means that you can basically, you have enough marketable assets to draw 4% off of it, and you're not really getting into the principal. And so that's really what this is kind of based on, is kind of this 4% draw off of your marketable asset number. And so that again, that's really what we want to get at, is a way to kind of keep track of how you're doing. And so what this also does, though, is for people who can manage their budgets better and keep their spend down, their need for marketable assets is not as great as someone who spends $40,000 a month. So in that case, the annual spend would be, $480,000 times 25, which, I mean, they need a ton of money at that point to do that. But so I really hope that we can delve into this more and talk in detail about each of these different ideas. And I'd love to get feedback on what your asset score is. And really, I want to see the progress on people's asset scores. At some point, I'll go ahead and plug my numbers into this so you can see and see what my numbers look like and see the progress I'm making, or hopefully making. And I just look forward to hearing from you. And I'd love for you to be a regular visitor at my channel and just be involved here. And hopefully everyone can benefit from this. And just hope that everyone can help each other out. Thank you so much.